Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, the voice of the people, Jeff Santorini. Hey Jeff.
So I know what you did there, but that's not what was said. For the listeners, my name was mispronounced by someone on a live stream recently, and I believe what he actually called me was Jeff Santoso. Which is disappointing because it's not even cool. Like if he had misnamed me Santorini, I might have just changed my name.
Yeah, that's pretty cool.
That's a pretty cool last name. But no, I believe, I'll go back and watch the video to confirm, but I think he called me Santoso, even though it was written on the screen for him to read. So
it's not even that if I don't want to troll somebody that's not here. So
the most common mistake people make with my name is I get an A at the end instead of an O, but I've never been called Santoso, I don't believe. So
I thought you were going to say they called you a name that begins with an A.
Oh, no.
I don't think that's a mistake. I think people are doing that on purpose.
Right, but this is a family show.
Is it?
I can talk about that behind the paywall at Patreon, but I can't do it here.
I was going to say, you know what's not family shows? The rough cut exclusives that we do for Patreon members for the $5 a month. Go check that out, patreon.com/investingpod. Give us $5 a month and we'll give you some fun stuff. Go check that out, everybody. All right. Good show planned, and definitely one of those kind of hard to answer questions that we're going to make a go at. The title for this show is it getting harder to find an edge as an investor?
And I think I hope this is an interesting conversation. I think it will be. That's why I pitched it. So you and I both subscribe to Ben Carlson's newsletter, Wealth of Common Sense. We had Ben on probably 5 or 6 weeks ago at this point. People can go back and check out that episode. It was a fun interview, but he writes a daily short newsletter post. You and I both subscribe. It hits my inbox at like the perfect time every morning, right when I'm sitting down to have a cup of coffee, need something to read. And he had one a few days ago called The Dumb Money Isn't So Dumb Anymore. And I'm not going to recap the whole thing because I think we'll cover it over the course of this conversation, but it got me thinking about whether or not people making smarter investing decisions writ large actually gives people like us a disadvantage. Does it make it harder for us to find an edge? And the quote that made me think of this as a fun conversation, I believe it's a Charlie Munger quote, who said, "If people weren't so dumb, we wouldn't be so rich." And I always thought that our edge as individual investors who focus on long-term buy and hold kind of investing, the edge we have is that stupid people will sell us stocks at good companies at good prices. That's sort of the edge we have in being patient and being knowledgeable about the company and what they're trying to do. And this post, and we'll go through it in a couple different ways, got me thinking about whether or not that continues to be the case, whether it will continue to be the case. So I thought it'd be a fun thing to talk about.
Yeah, I think so. And I think one of the fun things about it is that you and I think directionally, we largely agree in some of the nuance and some of the details. I'm taking the counter to this idea. I do think this is going to be a fun conversation. So I think we should just start with kind of unpacking a few of the kind of key data points that Ben broke down. By the way, that was episode 150 back in mid-April, if you're interested in listening to that, if you haven't heard it before.
Yeah, so I pulled out 3 quotes straight from his post that I think will frame the conversation. So let me just read the first one and then we can talk about it. So Ben wrote, "According to Barron's, professional investors were more bearish on stocks than they have been in at least the last 30 years. And he's talking about the April downturn after the Liberation Day tariff announcement. That's the context I forgot to give. And then he goes on to say, "The smart money got scared, these professional investors becoming really bearish. The dumb money, meaning just regular old people like us, rushed into the burning building. Maybe the smart money isn't so smart anymore." So his basic point is the professionals panicked and sold, and it was actually everyone else who saw the falling prices, ran towards the fire, and bought shares of the companies they wanted to buy at better prices. And that was the first kind of piece of this that got me thinking, interesting. And his point is maybe the thing we all think happens to everyone where they see red in the market and then they sell, which makes more red in the market, which makes more people sell. Maybe we're getting away from that as a cycle. So I'm not saying I agree. I know you pitched it as us being on the opposite sides of this. I actually might agree with you, but I thought it was a fun thought exercise. So I will continue to argue that he's right and this means we're losing an edge. Tell me I'm wrong.
Yeah. So a couple of things that I want to say just to define the smart money versus the dumb money a little bit further. So the smart money, we're not just talking about professional traders here. We're talking about institutional investors, fund managers. When I say fund managers, I don't mean people running ETFs. I'm talking about people that are running large pools of money that they're often managing for accredited or other high net wealth individuals, right? Hedge fund investors, that kind of thing. So people managing billions and billions of dollars of other people's money, right? When we say professionals, I think that's what we're talking about. People that are running money for pension funds. Sometimes the smart money is running money that at the end of the day goes to the dumb money at the end of the day, right? The dumb money just meaning individual retail DIY investors, people that aren't doing this as their job. So largely just retail investors. And one of the things that I don't know if it's in one of the quotes, but there was one of the data points that Ben used that was compelling was during that post-Liberation Day sell-off when the market was approaching a 20% decline, hitting that bear market number that, we see every 7 or 8 years. We just saw one of those in 2022, right? 2022. So right on the cusp of seeing another significant decline like that really quickly. And those typically take 6 months to a year or more from kind of the peak to peak to kind of play out. So it was usually when we get 17 or 18%, we get to 20% sell-offs. It's very rare that we get that close to it and don't. And what was the number? Like $40 billion of basically new retail money that flowed into the market in that period.
Yeah, JP Morgan data shows there was a record monthly inflow by retail investors in April to the tune of $40 billion.
So the dumb money bought the dip, right? I mean, I think that's the key. I want to throw something in there that anecdotally supports that. And I wrote about it in our Sunday newsletter. I think I published it on Memorial Day morning, but just wrote about taking a look back at my own usage of cash as dry powder and thinking about holding myself accountability. Where's a better way to do that but in the public realm that we have the opportunity to with those of you that listen and read what we do? And I went back and looked because I keep that cash specifically when we see 10, 15, 20+% sell-offs to use it. And if I'm not using it during those periods, then I'm being an idiot. I literally am saving the cash to use when we can have sell-offs. And I was in the middle of that. I actually participated in that. I did some buying in January, and then I didn't really buy very much for a couple of months. Just had some options, things I was doing, but in terms of buying new positions of stocks, it wasn't until kind of mid-ish April that I really started aggressively buying again. And I added to a lot of positions because my rules say, hey, the market is down. So I do think that that's a positive. The flip side, right, I'm going to take the devil's advocate position, is if retail doesn't do that, does the market go down another 5, 10%? And now we're looking back today and the market's still down a whole lot, right? And hasn't bounced back. Who knows? So I don't think we can play that out purely, especially with the catalyst that we've seen. We're recording this on May 29th. It was just yesterday that the International Trade Court ruled that the Trump tariffs under that 1977 law, whatever it's called, are unconstitutional. Either the law is unconstitutional if the law gives Trump or gives the president that power, because it's a power that the Constitution says belongs to Congress, and Congress can't just give that power to the presidency, or the administration used it in a way that is not allowed within the law. We've just steadily seen like things around the tariffs that are making it less and less likely that tariffs are going to tank the economy. So maybe the market does bounce back some, but it certainly does feel like retail investors kind of staved off a steeper decline.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb. You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Yeah, two things I want to add on to that. I don't think using your actions as a proxy for the market is smart because you're an outlier, I think, in terms of having a really disciplined cash strategy.
The idea is I'm supposed to be better than the average retail investor.
Supposed to be.
Right.
No, but because every conversation I
He's
had...
better than Jeff.
We'll see. Every conversation I've had with normie people who just don't follow this stuff except when it really breaks through, which is even harder to do these days with such a fragmented news environment. Every conversation I had with a normie was basically, oh man, the market, and not, oh, look at this opportunity, right? It was very doom and gloom. That's the first thing I wanted to just say. But the second thing I wondered when I was thinking about this article or this post and this conversation is there is a lot of people who came into investing around the time that I did. And I mean stock investing.
Yeah.
2019, 2020-ish is around the time when all of the rest of the online brokerages dropped their trading fees. And simultaneously, almost all of them picked up fractional share buying. So those were
those two things very much became mainstream during that period. Right.
And so I bought my first individual stock in February of 2020. And it was so simple to just pull my phone out of my pocket and buy something. And that is the environment in which a lot of younger people than us came into investing for the very first time. Now, so that same cohort of people lived through the mania, bubble, excitement, frothiness of post-pandemic crash 2020 and all of 2021 when everything was up and to the right. But they also lived through 2022. They saw that huge prolonged downturn. They experienced the crypto winter, which is significant because I think a lot of younger investors are more likely to invest in and play around in crypto. So I do wonder when they saw this, I wonder if they learned the same lesson I did from 2022, which was, and maybe even from the crash of 2020, which was, oh man, look at how all this bounced back. And I wonder if that's what caused more people to buy the dip, so to speak, in April of this year than maybe would have in past downturns, because you have this whole new cohort of investors who lived through 2022 and then saw what happened in 2023 and in the little bit of 2024 where everything recovered and kept going up. And maybe they said, you know, I was caught flat-footed in 2022. I didn't make enough buys, and this was the time to do it. I don't know. Maybe I'm giving too much credit to the dumb money, so to speak. But I did think about if their experience was similar to mine, they might have just learned the lesson and maybe dip buying, at least these shorter duration ones, will become more the norm.
I think there's something there, but here's where I kind of struggle with this a little bit. We'll start with the pandemic. The pandemic period was so atypical because of not that we saw governments provide stimulus. That always happens when there's a deep recession and some big economic shock, right? There's always stimulus that happens to some degree. Like the big thing that happened during the global financial crisis, and this was one of probably the biggest contentions of politically between Republicans and Democrats, was how long were unemployment benefits going to be extended, right? They kept getting extended. And of course, interest rates being kept so extremely low for such a long period of time. So those were like the contentions that happened around stimulus that was provided. And then during the pandemic, of course, trillions of dollars was thrown into the bank accounts of taxpayers in the US, regardless of income levels or need. So you actually had a lot of people, and I'm going to target seniors a little bit here. You had seniors whose pensions were not affected, whose 401ks recovered very quickly, whose Social Security, Medicare, other benefits like that were wholly unaffected, were getting the same check in federal stimulus, a family of two, that a married family of two near the bottom of the economic spectrum, that two people that were out of work would be getting, right? In terms of like extra money. Now, yes, there were, unemployment benefits and things like that and then the payroll protection plan that was put in place to basically pay for jobs for companies. Instead of people going on unemployment, companies would keep them on the payroll. They'd have these loans that would be forgiven, and it was just free money. But the fact that the stimulus was pushed out basically to everybody, right across the economic strata, was so extreme that you took that and you removed all of the other extracurricular activities that we normally had to be able to do because of the lockdowns and social distancing and things like that. And people just had all this extra money, and a lot of it went into stocks and crypto too, as far as that goes. But so much extra money went into the market that we saw this insanely fast recovery. And then the bear market of 2022 that carried in 2023, but the bottom of the market was like October of 2022. So the sell-off lasted about 10 months, and then the market started to roar back. It would take it about another year to fully recover. There was fear of a recession, but a recession never happened, right? The economy held up, generally speaking, perfectly fine. So all of that to say, the thing that I keep coming back to with this idea is we haven't seen retail investors writ large really feel any real financial pain, right? Sure, brokerage accounts have gone down, but we haven't seen unemployment spike to 5%. And now you've got a few 100,000 more people that are on unemployment, and they're cashing out 401ks and doing things like that. And of course, the market doing what it typically does when there is recession or like a real economic downturn happening, selling off, right? And then selling off turns into more selling off, and then the fear kicks in, right? So we had the wall of worry that we climbed in 2020, 2021, and then we had the bear market sell off. The economy held off. So the market bottomed out and started to recover pretty quickly and started climbing the wall of worry again. There's things to worry about, but the numbers are good, right?
Yeah.
I don't feel like we've gone through a period of economic stress to really test this theory.
I agree with you. I would caveat what you said slightly, which is I think in equity portfolios, people certainly felt it in 2022. But you're right, from the larger economic point of view, unemployment stayed low, wages stayed high, right? There wasn't like a 2008 style economic collapse, like the housing market didn't fall apart. And it was not that long compared to some of the other more memorable economic times of worry, right? So not as prolonged as the dot-com crash, or not as prolonged as the great financial crisis, 2008. So I think there was equity pain, but not economic pain. But
right,
in either scenario, it still wasn't so long that, you'd see like complete market capitulation and widespread panic. So I agree with you there. All right, let's look at the next little quote. This is making the same point, but in a slightly different way. So Ben goes on to say, there are now more set it and forget it investors than ever before. In 2024, just 5% of investors in a Vanguard 401k plan made changes to their portfolio. And there is now more than $4 trillion in target date funds. So more money is going into index funds and ETFs and out of actively managed funds. So again, kind of making the point that the dumb money may not be so dumb anymore, which is the name of the article. But I thought this was interesting. And so here's my first thought, and then I want to know what you think. This makes sense to me in the sense that if you're starting to invest right now, let's say you're a recent college graduate, you get your first job, you get presented with your 401k options, and there's all these funds you can choose from. So you Google, what should I invest in? Whatever you do to get the information. You're going to find a ton of information
it's
about
2025. You ask ChatGPT.
Yes, sorry. However you do it, you're going to get information about actively managed funds and how index funds are better and ETFs have lower fees than this. It's easy to learn now
Yeah.
that actively managed funds tend to not perform as well as passive funds. That's not something I knew when I was 22 setting up my first retirement account. I didn't know
Yeah.
what the difference between the two was, and there was nowhere to get that information. Like the internet existed, sure, but we weren't in the world of Googling something and getting an answer.
You didn't trust the internet to give you the right answer for that. This was the kind of thing that you're far more likely to ask a colleague or a parent or a trusted, experienced family member, advisor, so to speak, and you're going to get one of two answers. You're going to get I just have it spread across the funds in the 401k. Chances are, particularly if you work for a small to medium-sized business, which is the majority of people, whoever manages their 401k, they've probably just got a bunch of funds in there that they're making good fees income off of. Again, this is going back 15 years. And it's still this way to a certain extent, right? It's not as pervasive. But there was a relationship that somebody in management had with somebody in the financial advisory world that was making good money on fees that brought in a mediocre product, right? And you just didn't have any other choice. If you went to your parents or a trusted advisor, an older person that had some wealth, they were going to give you their guy, right? Who was their financial advisor, who was going to put you in some shitty American funds, actively managed funds that they got a front-loaded fee on. So they get a big commission and you take an immediate haircut and you don't even know it, right? And they're actively managed funds, and most actively managed funds are going to underperform the market. And yeah, I know it was maybe a little unfair to American funds because they do have some good ones, but speaking writ large about how the industry was structured, that's very much changed. People are far less likely to ask a human what to do than to Google it or ask an AI, right? It's true.
Or find a podcast or find a Substack or find a social media account, whatever.
And we're largely regurgitating some of the same stuff that luckily Jack Bogle started to make happen with these low-cost index funds where you can just buy the market, remove all the difficulty of finding a fund that's going to perform and outperform, reduce your fees, right? It's become the dogma that just happens to largely be true for most people, is it's the right way to do it. I want to focus on one thing though in those quotes. I want to invert a little bit here. The quote was in 2024, just 5% of investors made changes. I want to focus on the more important side of that. And when you invert it, it's that in 2024, 95% of investors in a Vanguard 401k did nothing. That's the big one.
Mm-hmm.
And you know what happens for a lot of those folks? Their 401k contributions every year automatically go up 1% or 0.5% or whatever that's the choices now, right? For most of these plans, like when you sign up for it, it pops up and it's like, do you want to increase your contributions every year? And of course, yeah, of course I do. Duh. Yeah, of course I do. Instead of having a salesperson sit across from you, that human nature is going to be like, Jeff, and you've talked about your experience with this, right? It's like, this is a salesperson. Do I really trust them? They're asking me for more money.
Yeah.
A pop-up on your 401k sign-up screen is giving you good advice. Isn't it funny, like how we just perceive that so differently?
And the friction is a lot less now too.
It's gone.
When there's still friction in my profession where there's sales reps and it's 401k plans, but I know for my wife who just works for a company, she just logs on to the website for the retirement account and just clicks a couple buttons and increases her contribution or changes what she's invested. It's just stupid easy. It's as easy as us logging on to Fidelity to buy a stock.
Yeah.
So that certainly has changed over the past 20 years too.
And what I would argue is that this is less a product of the dumb money not being so dumb and more a result of the industry just doing a better job to remove frictions that hurt retail investors, that get in the way of retail investors and getting better returns, which honestly is not great for, if you're a wealth advisor, you're a big fund manager, you want this stuff to be just as slick as it can possibly be, because it grows your assets under management, which grows your revenues. I mean, it's pretty simple. So I would say that a combination of, yeah, like that baseline education, I do think that that's helped. It's certainly helped because it's what people know now, but also making all of those things automated means that people don't have to log in and see that their account is down and move it all to cash because they're afraid, and then don't remember to go back and reinvest it. Those are the actions that are so just destructive, that less of those things happen because the automated stuff is in your best interest and you just don't mess with it.
Yeah, agreed. All right, here's the last quote. And I think this is where I think we can have the most fun debating this. So Ben writes, does this mean retail investors are perfect? Of course not. There are still plenty of people
Some of us are.
Some of us are, right?
Some of us are.
There are still plenty of people who speculate, employ too much leverage, chase fads, trade short-dated options, and invest in stuff they don't understand. But that's always going to be the case. You can't save everyone. If everyone were a disciplined long-term investor, long-term investing wouldn't work as well as it does. And it's that last sentence that got me thinking, are we losing our edge because people are getting better at this?
Yeah. A couple of things. Actually, I'm not even going to say that.
I'll say something first because I'm of two minds of this, assuming it's correct, right?
Yeah.
One is I care deeply about financial education. I'm an educator. I look back at my own life and realize, man, if I knew half of what I know now when I was 22, I'd be in a much different place financially. I am on fire about making sure younger people in my profession know more than I did. I want to make sure my kids understand this stuff to the extent that they need to. On the other hand, I'm sort of relying, if I'm thinking about this logically and cold-heartedly, I'm also relying on stupid people who aren't long-term investors doing dumb things to help my returns. I mean, I'm not wrong.
Okay. Yeah. Sort of. So
Probably not to the degree that I'm making it out
Right.
for the sake of argument.
Well, I mean,
but
hyperbole, is fun. So my background, I've talked about my path a little bit, but the reality, if it just boiled down to maximizing my wealth, I would have stayed in sales. I would not have decided to become a financial writer because I cut my income by like a third my first couple of years, walking away from a pretty good sales job that I was really good at. But I wanted to do, like, I was led, I felt purpose, right? We want work with purpose. And I was really driven by being able to help people make better investing decisions, right? So becoming a financial writer helped me find purpose in my professional life. And then that's just extended through everything that we do here. I'm with you on that, right? There's absolutely no doubt about it. Here's where I draw kind of the line on this idea of losing an edge, or of losing our edge. Number one, there are some kinds of investing actions that are zero sum. Options largely are zero sum. Not always, but largely are zero sum. There are winners and there are losers in options trades, largely. If you are short-term trading, right, it's zero sum. But I think when it comes to buying and selling stocks, if you have the long-term mindset, it doesn't have to be that way. If we optimize the idea of being long-term investors, and in a pure state, we're buying businesses because they're going to help us create wealth and generate income. And we're selling those businesses because we don't need to own a business now. We need money. And we're not selling it because we don't want to own the business anymore. We're selling it because we need to convert that wealth into cash. The person on the other end of the trade is in a different place in their financial journey, where they can acquire that asset at what they think is a fair value, and then they can go on their compounding journey as an owner. And I realize that like nirvana bullshit doesn't exist, right, in a free market, right? There are plenty of times that we're selling stocks because they suck, because we made a bad buy of whatever reason that have nothing to do with us needing money. So there's a reality there that sometimes you're selling a stock that you think is a dog to somebody that thinks it's a good business, and you're right, and they made a bad decision, but they were your bag holder, right?
Right.
So that is a reality of operating in this kind of business, but it's not zero sum, right? In the aggregate, it continues to create wealth because these businesses grow more profitable over time. I would also posit that the idea that the dumb money is getting smarter and is being more automated and is owning more assets. And this is my biggest counter to the idea that this is killing our edge, is that yes, buying the dip is an edge. And if retail investors are staving off deeper sell-offs that would give us better chances to buy, yeah, I mean, that trims some of our edge case opportunity, especially for investors like me that do keep more cash to look for those opportunities during market dips. But my biggest counter, Jeff, is the stock market operates on the purest of economic principles, and that's supply and demand. And if you have more retail investors willing to hold longer, willing to invest more of their capital, you have more demand. Higher demand means that multiples will hold up, and that should result in similar or even better returns over the long term.
Yeah, I think I agree with what you're saying. So that last sentence that I read, if everyone were a disciplined long-term investor, long-term investing wouldn't work as well as it does. And I think it's the as well part. So
Ben has a lot of nuance in this that I think is exactly right.
So let's play this out. Let's say that $40 billion that poured into equities from retail investors in April didn't happen. And to your earlier point, maybe the market falls further and stays lower. That's a lost buying opportunity for us, right? For the smart, dumb money that would have bought the dip.
Right.
But
yeah, so case in point. Again, it's just anecdata with my situation, but as of the most recent kind of where the market's valued are, I still have more than 10% of my portfolio in cash. I was over 20% back in late March. Well, early April when I made my 401k contribution, I was over 20%. So the point is that I still have a little more cash than I typically would.
But you said something else that I think is why I don't think this would ever actually happen. And here's an example. So I'll just use NVIDIA as the proxy here for this example because it's a stock everyone talks about. It's gone up a lot in the last bunch of years. So 5 years ago, the stock was about 1,500% lower. Okay, so if you bought on today 5 years ago, you would have turned $1,000 into $16,000. Okay, this stock has just been on an incredible run. So on that day, May 28th, 2020, you could have bought NVIDIA stock split adjusted for $8.48. That day that you bought that stock you could have bought the stock from two different types of investors. You could have bought that stock from the person who's like, NVIDIA is a trash company, I'm selling it. Or you could have bought it from the 75-year-old who had owned it for 15 years, who just needed to sell a couple shares to pay their living expenses for that month. And that will always be the case, right? When you're buying shares, yes, you're buying them from someone who's selling them, but the reason that person's selling them could be completely legitimate, funding retirement, or it could be running away from a fire during a down spell in the market. I agree with you that I don't think this ever goes away where being a smart, patient investor leads you to no edge. But I do think over time, the combination of better financial education, better maybe understanding of behavior in investing, more people listening to our podcast and being able to manage their emotions could actually diminish the edge we have trying to turn other people's lack of patience and lack of discipline into profits for us, but not to the point where you can't be successful following a smart long-term strategy. I think that's where I land with this whole idea.
Yeah, I think that's right. And I want to build on that NVIDIA one just as an example, because I think it's an excellent one that kind of puts the point to what we were talking about. So that May 28th of 2020, right?
2020.
2020. So if somebody bought in May of 2009, I'm just using that because that was financial crisis. Things were ugly, but NVIDIA was fine. Like the stock was pretty beaten down, but I mean, there weren't like worries that it was going to go out of business. But let's just say somebody's like, hey, it's a good dip, I'm going to buy some right now. And let's say May of 2020, pandemics happened. They've decided to retire. They want to sell off and raise some cash. NVDA had been a six-bagger for that investor, right? It was up 527% from when they bought it in May of 2009, like 14% a year average. It had beat the market. It had done really well. And they were just ready to cash out. So they weren't necessarily somebody that was selling it because they were worried about the business being in trouble. They were just doing investor things based on investor goals. So here you go.
Yeah, exactly.
Okay, I got one more point that I want to make here, Jeff. We can wrap this up. As much as I hope, frankly, I hope that there is some truth to what Ben wrote about, that the combination of better information that's just kind of become the consensus of the way that regular people think about the stock market, and that's that we go through these bad periods and you have these dips, but picking stocks is hard and most people shouldn't do it, and actively managed funds are not great, and you should just own ETFs and you should make things happen automatically. Like, if all of those things continue to become more and more pervasive, I do think that it does potentially have the likelihood of kind of hitting some of those sell-offs. Maybe not the really deep, like economic shock level ones, like the financial crisis, which, I mean, that was economic world coming to an end level kind of stuff. That was really scary stuff. And I don't give a crap what you read on Investopedia, right?
Yeah.
Fear is going to kick in at some point, and financial necessity too, right? Where people need to sell stocks for money because they lost their job and they don't have a choice, right? Those things are going to happen that are going to perpetuate those sell-offs. But I do think even if it does soften kind of some of those sell-offs and make the market a little less volatile in general, I'll take that all day. I'll take that all day, because it means a hell of a lot more people have a little bit better safety net in their life and are getting closer to financial independence. And that buoyancy is going to help you and me in the long term. When it's our turn to sell, there's going to be a market for buying from us. But I also think that there's always going to be pockets of uncertainty. The banking crisis we saw back in 2023, as an example, what happened with DeepSeek and what it did with AI stocks, there's always going to be those little pockets that kind of blow up that are going to create an opportunity. And I think for the kind of investors that we are as stock pickers, looking for those opportunities in addition to just adding to our winners, I don't think this affects our edge there at all, because writ large, if you're investing in funds, sure, you don't get to buy the dip opportunities in the large scale funds, but I do think there are going to be different cohorts of stocks that are going to get hammered from time to time, and we're still going to be able to find those opportunities and do really well adding to those, buying those dips in addition to just doing our regular adding to our winners.
Yeah, I'd agree with that. And I think the last thing I would say is, as long as there's still people buying crypto meme coins, I have confidence that there will be dumb people out there helping to make us rich. So that's a preview, by the way, of a future exclusive rough cut on the Patreon. I do want to have a conversation with you, an honest conversation about crypto, because I've had a lot of thoughts recently. So little tease for the audience here. So speaking of other things to think about, if you guys have enjoyed this episode, we appreciate if you would share it with a friend, and also give us a rating and a review on the podcast apps. And if you want more content, you can check out our YouTube channel. You can check out our Patreon. You can subscribe to our Savvy Trader, and you can subscribe to our newsletter. The links for all that stuff is in the show notes of the episode. So check that out.
Yeah, go check it out too. One thing we didn't mention that I want to just touch on real quickly too, with our Patreon, with the starter position, $5 a month premium, you get access to our Discord, and we got a lot of conversations going on right now around stocks and earnings. It's been a lot of fun interacting with a lot of you. So for those of you that have joined, just a hat tip here to, let's see, we got Saneeth, Lewis F. Brooks has joined us in there. 2X Sales, who some of you know under another name, Lowy has joined. A lot of people jumping down the conversation. So sign up, give us that $5 a month, and we'll get you into the Discord too. Hopefully we get more of you there. Hopefully we're not selling it too much and pissing people off, but we're doing it at the end of the episode, so most of you are already gone. Right, Jeff?
That's the goal.
Yeah. Well, it's time for us to go too. Okay, everybody. As always, we love to give our answers to these hard investing questions, dig into the nuance, and work through the details. But it is up to you to find your own answers to those questions. You can do it. I believe in you. All right, Jeff. We'll see you next time.
See you next time.